Welcome to the deep dive. Ever wonder how you really tell if a business is, well, doing okay or maybe struggling?
Yeah, it's not always obvious from the headlines.
Exactly. So today, we're looking into financial ratios and variance analysis. Think of it as our shortcut to understanding a company's real financial health. What's working, what's maybe not.
Right. We're moving beyond just raw numbers to see how they relate. We'll hit four main ratio types. Profitability, are they making money? Liquidity, can they pay their immediate bills?
Okay.
Solvency, how secure are they long-term? And we'll touch on performance too. Then variance analysis, comparing actual results to the plan.
Got it. Let's dive into profitability first. Crucial stuff. We have data for Gen Company. Year two gross profit margin, 44.44%. What's that telling us quickly?
Okay, so 44.44%. Basically, for every dollar to sales after they paid for the goods they sold, they had about 44 cents left.
Left to cover everything else.
Exactly. Operating costs, interest, taxes, all that. It's the first big hurdle for profit, a healthy sign here.
Right. And then the overall profit margin, that was 11.11% in year two.
Yeah, so after all the costs, everything, they kept about 11 cents profit from each sales dollar. That's the bottom line.
The real takeaway profit per sale. And return on assets, ROA, 7.2% for year two. How's that work?
ROA shows how well they use their assets, buildings, equipment, cash to actually generate profit.
Yeah.
So 7.2 cents profit for every dollar of assets they hold.
It's about efficiency then.
Exactly. And there's even a deeper dive, the DuPont formula, which breaks ROA down further into profit margin, how fast they turn over assets. G's was 7.22% there. It helps see why the ROA is what it is.
Okay, interesting. Let's shift to liquidity, short-term health. G's current ratio in year two was 1.03, down a bit, and below the industry is 1.50.
Yeah, 1.3 means our current assets barely cover their current liabilities. It's quite tight.
Compared to the industry, definitely.
Right. Below 1.50 suggests they might not have much flexibility if something unexpected comes up. Less wiggle room.
And the quick ratio, even stricter, right? That was 0.62, also below the industry's 0.80.
Yes, stricter because it pulls inventory out of the equation. Inventory isn't always quick cash.
Good point.
So 0.62 reinforces that tight liquidity picture. They rely quite a bit on selling inventory to meet short-term needs. We also see it took them like 61 days to collect receivables.
Wow, 2 months.
And inventory sat around for about 106 days. So things aren't moving super fast on the short-term asset front.
Okay, let's look long-term. Solvency. Their debt-to-equity ratio improved, actually, down from 1.04 to 0.91. Good news.
Generally, yeah, that's positive. It means the company is funding itself with less debt relative to owner's equity compared to the previous year.
So less risk for the long haul.
Usually indicates that, yes, a bit more financial stability, less dependent on lenders.
All right, let's switch gears completely. Variance analysis. We've got Neostar Corporation. The first report comparing budget to actuals looked not great. Unfavorable variances.
Right. But that first report can be misleading. It just compares the static original budget to the actual results.
What's the problem with that?
Well, what if Neostar sold way fewer units than they budgeted? Their revenue would naturally be lower. Costs might be lower too. It doesn't tell you why things differed beyond just volume.
Ah, okay, so you need to adjust for the actual sales volume.
Precisely. That's where the flexible budget comes in. It recalculates budget figures based on the actual number of units sold. It gives you a much better comparison.
So what did Neostar's flexible budget show?
It helped isolate the real issues. Even after adjusting for the lower sales volume, we saw they had an unfavorable sales price variance.
Meaning they got less per item than planned.
Exactly. And they also had unfavorable variable cost variances, meaning it cost them more to make each unit than planned.
So it wasn't just about selling less, it was about price and efficiency too.
That's the key takeaway. The flexible budget separated the volume problem from the price and cost control problems. Much more insightful.
It really highlights how these tools work together. Ratios give you the snapshot, variance analysis digs into the why behind performance changes.
Absolutely. The math isn't the hard part, really. It's understanding the story the numbers tell, within the company's context, the industry context.
And Neostar really shows how that initial simple comparison can sometimes, well, miss the real story.
Definitely scratches the surface. You need that deeper analysis.
So here's something to think about. How could getting a bit more comfortable with these financial tools, ratios, variances help you make smarter decisions, maybe in your job, your investments, or even just understanding the business news better? That's your food for thought.